Welcome to another VC Wisdom podcast. We have Benjamin Narasin with us today, okay, Ben Nasarin. He is the founder and a GP at Tenacity Venture Capital. You can pitch him with one line elevator pitch if you'd like that. But yeah, he's been VC for quite some time now, invested in a bunch of companies here that I see on his LinkedIn here, including Zenefits, including Bungle that I see here, Lending Club, Divi. Ben started in a startup himself in '93. So I see Fashion Mall here. He's been an entrepreneur and a CEO before he became an investor. So Ben, welcome to the pod. Tell me a bit more about yourself and what you're up to.
Sure. I mean, you got most of it. I was an entrepreneur for 25 years. That culminated in starting fashionable.com in New York City, which is where I am right now, started in 93, took it public in 99, and then took it private in '01 because I had basically bootstrapped it to the point of the underwriter's letter. Then I moved west, got to California about 22 years ago and started what ended up being one of the first two institutional seed funds, and have been doing seed investing ever since. I also spent about 7 years of the last 18 years as a traditional VC, mainly at NEA, where I did later stage rounds as well.
And in between all of that, you were also a freelance wine, food, and travel writer.
Yeah, there's a lot of respect for what people do. I interviewed two different families, heads of families out of Italy that were like 23rd and 4th and 5th and 6th generation winemakers. So a lot of history there. I mean, I've collected wine. We don't drink much. Now I've sort of shifted to spirits. I do a lot of parties to get my entrepreneurs together with VCs and strategic investors and corporates that can help them. And usually it's a lot easier if you toss a $10,000 assortment of whiskey or wine into the mix.
It is. And why have you stopped drinking? I'm a biohacker. I'm in the capital of Mezcal here in Oaxaca. So every weekend I like a little mezcal because it tastes so good. It relaxes my mind, but I can see the negative effects on my sleep. So why did you stop on your side?
Well, I never stopped. It's just never been a particularly important part of my life. I am more intrigued by the history and heritage of wines and spirits from different regions than I am by drinking. I mean, we will have on average 0 bottles of wine that we'll consume in the house, but if I have people over, then I'll open a bottle. I had an LP in from Australia. We went down to the cellar and pulled out like a beautiful BV from the 80s that just drank perfectly. Corvin did it and it was really great. I've moved to more spirits because if I throw a party and I spend a lot of money on, I have sponsors for this and they know I'm going to spend all their money on things we can eat and drink. And I open a $5,000 bottle of whiskey and we use half of it, the other half is good for 10 years. If I open a $5,000 bottle of wine, it's good for a couple of days at most. So, I have a great fire pit. If people come to meet me in the Bay Area and it's appropriate, I'll have them over at the end of the day for a glass of whiskey and maybe a cigar. I don't mind drinking. It's just not, maybe I have 2 drams a week.
And what are some startups that you invested that went up in value, just like a fine wine?
Well, I don't have any wines that are worth anywhere near as much as my best startups. I mean, Rippling, which was Parker Conrad, who started Zenefits, which I invested in as well, is now worth $16 billion. And I was in his very first round at Concept. One of my companies in New York City that I personally invested in called Clay AI has been doing exceptionally well. We just because of the fact that I now run a fund, I no longer do direct personal investing. I've only done one investment of my own since I started this fund, and that is a company called Hippocratic, which is also doing quite well. It's an AI-based business that creates digital nurses. So that one, I put in money because one, first of all, I'd known the founder for 30 years. 2, it was a Series B at a $500 million valuation, but I really believed in the business, and it is in medtech. Now, as a fund, we do not invest outside of seed. We do not invest in medtech, and we certainly can't pay $500 million. So I got LPAC approval to do that one personally because I've known that entrepreneur for so long, and I also invested in the business that didn't make it. So I'd like to be in the one that works. But we as a fund invest in anything tech except security, medtech, and crypto. I think in the last 18 years, I've had, including my own company and one that I ran, or there was a division of my company. I ran 7 companies that have become public. Omada Health, which I funded probably 12 years ago. I did their seed and then introduced them to their Series A investor, just went public. So, I think that made number 7.
Interesting. And why not stay a founder, an entrepreneur? Why did you get into investing specifically?
Well, I took my company public, then I took it private. I got liquidity. I actually retired for a while. And then when I moved to California, I saw this gap in the market between angel and venture and felt like that opening was a great one for me to go after, hence the creation of one of the first seed funds. I did assume, so I was running the equity practice of a venture debt shop. I thought there would be a very good chance I would end up finding a company that couldn't repay its debt, that they would own, that I could take over and run. But in the end, what I realized is it is better to live vicariously through many founders than to be a single founder. And so I've just really fallen in love with what I do. I get to, as I said, live vicariously through these founders. I get to be helpful to them. I'm not a high maintenance guy. It's like I have only 2 rules. I have to see you once a month. You can see me anytime you want, and I'll help you raise your Series A if I think you're ready, not if you think you're ready. I know 327 VCs, the top 15 funds. I can get you to the right people at the right time. But it took me a long time to build those relationships, so I need to make sure they're going to appreciate the introduction.
Interesting. And what's your thesis on founders? What skills are you looking into them? Is it a specific geography? Is it a specific background? Tell me a bit more how you identify these super deals like Rippling.
Well, I always say I need 5 things to make an investment. People, a great idea, and a huge market. I do not invest in brilliant founders with bad ideas. I've tried that. It hasn't worked for me. I'm not a fan of pivots. Geographically, it is North America and LATAM. I'm really impressed with the companies I've invested in LATAM. Capital is an absolute star grower. BitSports, also known as FanKey, doing exceptionally well. Midas down there, a lot of promise. So I'm going to start to spend more time on Latin America. I've been down to Mexico City 3 times this year. I used to do the UK. I'm dropping that. I'm unimpressed with the syndicates there and think they provide a disproportionate amount of risk. A lot of bankers that call themselves VCs and definitely are not. But the fund is named Tenacity for a reason. The only secret to entrepreneurial success is an absolute refusal to ever die. You've got to be brilliant. You've got to have a great idea. You've got to have a huge market. But if you have all that and you don't have the drive and the grit and the wherewithal and the tenacity, it's not going to matter. Being an entrepreneur is the hardest job in the world if you're not a first responder. It is the hardest office job in the world, period. And a lot of young folks get into entrepreneurship not realizing how hard it is. And that's when your mettle is tested. There's an old saying that, iron becomes steel by going through fire. Same thing. It is incredibly hard. And if I don't think you can weather that storm, then I just can't fund you.
And what bullshit do you see in the VC world right now that, you identified while most wouldn't speak about it?
Well, I think over time, there have been some very obvious cycles. And there's been some BS lines from VC. So I'll tell you an example of that. Every time there's a correction, so 2021 was sort of the peak of the sugar high, the ultra high valuations, growth rounds being done at crazy numbers, pre-IPO rounds that never turned to IPOs. After that, things got hard for VCs, got harder to fundraise. All of a sudden, people are upset. The LPs are yelling at them. Maybe not yelling at them, but they always say the same thing. Well, a lot of people lacked the discipline during this bubble, but we didn't. We maintained discipline. We maintained pricing. Bull. They just all look, you can't, the business of being a venture capitalist is not a seasonal business. You do not get to tune out. You invest in good times, you invest in bad times. Companies are created of substance in all types of times. But if the market price goes up, unless you want to lose every deal, now you have to be more selective. So I think one of the things is the sort of we maintain discipline. They didn't. The things I look at is sort of the fatal flaws in venture. 1, greed for fees. You decide that because you could raise more, you do because you're going to get paid fees. That is a incredibly short-sighted thing. You give the fees back before you get carry. Fees are a 10-year interest-free loan to run your business, but you make real money in carry from being a good investor. The second thing, which is related to that, is growing a fund size when, all it does is create fees, because as people have often said, tell me your fund size, I'll tell you your strategy. I had fund one where we set out to raise 50 million. We were oversubscribed, so we took 60. I don't think there was any benefit to me to do that. When I'm raising fund two, which, I'm only going to take 50 or maybe even less, because it's not productive for me to have more than I need. And normally what happens, by the way, when people raise more than they should, is they lower the bar. They say they don't, but they're full of it. They are lowering the bar. And when you lower the bar, that crushes returns. You end up with, there is nothing more time consuming and painful than having a company that doesn't perform. Now, obviously, some companies are not going to make it. That's life. That's venture. But when you lowered the bar in the first place, you're going to have that happen more often. And that's a huge challenge.
And what do you do when a company is not performing? Is it more mentoring, sometimes more capital, more resources for sunk cost assumption, or what's your model here?
I'm a one and done fund. I only put in money once. There is no more money. I put all the money in up front. So whether you're going, my single best company, I put money in once. The company that went out of business, I put money in once. It's just the model I practice. It has worked for me over time. It is always penciled. When I back tested, it's the right answer, because that's where you get the biggest multiples. But I'm not going to abandon an entrepreneur. Usually what it means is a significant amount more time spent to either help, where you are trying to mentor, you're trying to give them resources, trying to point them in a certain direction, just trying to be, but sometimes you're just a shoulder to cry on. And even when it's clear to me they're not going to make it, you still have to be there for the founder. I was a founder for 25 years. I'm not going to abandon somebody just because they're about to fail. That's one of the most painful times in their life. And, it's not paying any bills, but it's sort of a part of the human that I am that I can't get away from.
Right. And what's your home run rates nowadays? What are you aiming for in terms of returns over, let's say, 10 startups that you'll invest in?
So if you look at the history over the last 18 years when I analyzed it, there's a couple ways to look at it. One, the companies I invested in have tended to go on to raise follow-on rounds after me. Traditionally, I seed them and they raise a Series A between 63 and 74% of the time, which is, to my knowledge, the highest number I've ever heard. I've met one person ever that said they had a 50%, conversion rate. I worked at a venture fund where 10% of the companies we seeded converted into Series A's from that fund. On the fail side, it's sort of 24 to 35% per fund period. Keep in mind, I'm talking about my prior personal history, have lost me money. But, so that means in the area of 60% plus, 65 to 3/4% of my people go on to have something. Now, whether that's a home run or just a business that keeps going and trying to make it. It's been interesting. I haven't had any liquidity for the last 4 years. Very few people have. But in the last month or two, Omada Health went public. That was like 12 years in the making. One of my companies tendered at 80 times what I paid, and I sold a couple chunks of that because it was before my fund. And I really need to pay all my time and attention to my fund. And then another company that was sort of a zombie sort of reported back 2x. And then another company got written off because after 10 years of trying hard, she just didn't make it, and it came to an end. So, I've generally been exceptionally happy with my fund performance historically and my investments overall. I have been told that my track record as an individual investor is top 1%. And AngelList recently told us that the fund I have now is in the top 2% of the pre-seed and seed funds that exist.
And can it be frustrating or boring sometimes to wait like 12 years until it pays off?
Oh, of course. But, what are you going to do? That's just life. I bear it till the end. The thing is, if anybody listening to this were considering being an investor in a seed fund, one of the things I always tell folks is it's a 10-year hold. I used to say it was a 7 to 10 year journey. Now it's like 10 to 12 to 15 because there's so much more private capital for people. So, this is not a category for impatient money. This is a category for people that are willing to play the long game. but it's an extremely lucrative category when it works out.
And are you constantly raising from LPs nowadays?
I mean, it's funds are, I'm not sure what, I think I'm, it's an interesting question. I'm not sure I'm allowed to answer. But net, you raise a fund, you deploy that fund. When you're about 70 to 80% through that fund, then you raise the next fund. I have probably the rest of the year to deploy fund one, and then I'll have to be dealing with fund two deployment.
And who's your ideal customer persona for that? Is it family offices? Is it global? What are you looking for?
Well, right now, so fund one had 40 different VCs, whether they were funds or GPs or partners or founders of those funds as LPs. A lot of founders, sort of exited founders, family offices certainly are a material part of it. Fund of funds are another part of it. I don't have sort of the old school institutional LPs like an endowment. We're way too small. For fund two, I would like to find more value-added LPs, whether that's from geography. So as an example, I want to do more in LATAM. I have some LPs in LATAM, but I'd like to have more. I'd like to find more folks that can help my entrepreneurs. A lot of my entrepreneurs, as an example, exited entrepreneurs will help my entrepreneurs. So like, I funded Lending Club. Renaud LaPlanche is an LP. He has a new business called Upgrade. He has helped more than one of my entrepreneurs think through sort of strategy as relates to fintech. Munjal Shah, who I invested in at Hippocratic, is an LP. He really helps me think about generative AI and how one builds a moat there, and helps me with diligence on a team. And so I've got a LATAM family that's extremely material in LATAM, and they helped me when I was underwriting a deal there to get to the sort of heads of banks and talk through what that opportunity could look like. So my attitude is I would like all my LPs to represent more than just cash. I'd like cash plus another value. I'm open-minded as to what that value would be. By the way, one of those values is being able to directly invest in the companies, because as a one and done fund, I do take pro rata rights, but I take them for my LPs. I do it so that my LPs can ultimately invest in my best companies.
Right. And what's the average check size, and how quick do you deploy? Why would they take your check and not this other VC next doors?
So I write $1 to $3 million checks. I'll go less if I can still get at least 10% of the company, but I won't go more. And sometimes we co-lead. We usually are the lead. We usually set terms. We usually price rounds. We use NVCA standard terms. So it's relatively rare that there's room for somebody else. That's just the nature of venture when you're trying to buy enough ownership. I'm willing to do a lot of work to help my entrepreneurs, but I have to have enough ownership to justify that, or I'm doing a disservice to my LPs and to my fund. So I am pretty aggressive about trying to maintain the minimum ownership levels that I need to achieve. But a huge part of my job is to leverage that network of 327 VCs at tier one firms, so that when my entrepreneurs are ready to raise a Series A, I can make that process easier for them. I can't guarantee them an A, nobody can, but I can get them to the right people at the right time.
Interesting. And how are you leveraging AI in your fund?
Well, I have found that AI can be, in essence, a very effective digital associate. So when I was at NEA, as an example, there was a phenomenal tier of associates and principals, and even, they eventually graduate to become partners, that would help you when you were underwriting a deal with deep, deep analysis. Well, ChatGPT's deep research is pretty flippin' good. So, I'm not asking it, should I make this investment or not? But I'm saying I need a landscape of this category. I need to know the competitors. I need to know this geography. There's 100 questions you can ask it and get very detailed information back that in the prior world would have taken a person the whole weekend plus some, or I would have had to burn up an enormous amount of time. So I really like AI for that. I'm not convinced I can use it effectively to discover companies. I mean, in 2023 and 2024, I think I mentioned this, I saw 10,000 pitches. I funded 6. So it's not like I need more deal flow. Obviously, I always need more quality deal flow. I don't want to miss out. But, so it's mainly on the analysis side, on the work that a traditional associate would have done. That's very valuable for me on the AI side.
Can a founder be a good VC, and can a VC be a good founder, or are both not necessarily compatible in skills?
The first, yes. The second, not, unless they already were a founder. So when I first moved to California, I didn't believe you could be a good investor as a VC unless you had previously been a founder. I've come to realize that's not fair. Some of the best investors in the world were never founders. Scott Sendell, who runs NEA and is probably in contention for the single best venture investor of all time, was an operator at Microsoft, but he was never a founder. Mike Moritz was a journalist. Bill Gurley was, I want to say, a bank analyst. I mean, bottom line, these people were not founders. There are great founders that have become VCs. Reid Hoffman's an excellent example of that, and there's others. What usually doesn't work is, and it's usually the young folks, some young. So one of the problems in venture right now is that the associate tier of tier one firms goes like this. You go to a famous college, usually an Ivy. Then you get a job at a famous bank, one of three. Then in the first year, before you even started the job often, one of two recruiters finds you and takes you on a roadshow and introduces you around to VC firms. And then they have to bid on you and they give you an offer for a job a year later. Now, this has bubbled up a lot because you've seen it in the press. The banks are now saying, if you do that, we will fire you. But what the VCs are looking for is somebody that has the analytical skills to do the work on behalf of the partner, to help them make the decision and get that work that I just described that I'm getting ChatGPT to do for them. When those people become VCs, they sometimes become envious of all the money the entrepreneurs they back have made. And some of them think to themselves, I'm as smart as that guy. I'm smarter than that guy. Which isn't the point, but they don't understand that. Because while they're very smart, they have not yet gained wisdom. And so they decide to start a business. And in my experience, the worst pitches I've ever seen were from those people because they never were. All they see is the success. They don't see the hardship. They don't see the ones that didn't make it. By the way, even the ones they see that didn't make it still made it to venture funding. It's like, it's like they didn't see the stuff that came before. And by the way, these are usually relatively arrogant people. They're the people that, quite bluntly, piss people off. They're the people that when some entrepreneur that quit their job to risk everything, to fight, to win at some business, goes in to pitch, and they've been doing this for years. And then some young associate's like, I think you should do X. And they're like, wait, what? I'm sorry, where's that coming from? Oh, well, I went to famous school X and worked at bank Y. Uh-huh. Thank you for that. And you see this on Twitter all the time. There is nothing more frustrating. Look, there are a lot of great associates. It is, to me, unfortunate that they all come out of banking. I'd like to see diversity. I don't care what you look like, where you came from, what your heritage is. My portfolio of 100 and close to 80 founders is a rainbow of color and gender and everything else. It's intellectual diversity that I care about. And if you've got 12 people from different backgrounds from their genetic code that happen to all be bankers, you're not giving me diversity. I think diversity is missing right now in a way that we really need to think about. And I think the fact that we get fewer and fewer entrepreneurs in venture is a tragedy.
Yep. Last question, how is AI changing the VC landscape and how is it changing the startup landscape?
Well, for the VC landscape, it's primarily just an exceptionally exciting investment region. For the startup landscape, I don't need you to be an AI company, but if you don't have a strategy to leverage AI, then I don't think you're really thinking this through. The productivity increases you can have there. I don't like it when people just paper over their existing business by adding, it's now AI. But you need a strategy to utilize AI, whether that's in your developer stack, whether that's some co-pilot approach, it doesn't matter what it is. What matters is you've got an incredibly powerful software-based tool. You have to find a way to fold that in and use it. The most recent business I invested in, a company called Wildfire Robotics. It's a wildfire fighting robot, as the name would lead you to understand, out of Canada. Now, today, they're building robotics. And I'm sure they use AI in their work to make a better robot. But over time, they'll embed AI in that robot to make better decisions in fighting that fire. So they have a plan. It's not yet a critical part of what they do. I mean, firefighting equipment hasn't been changed by technology since the 70s. So I'm very excited about that one. And can also, I'm not a double bottom line investor, but it is really, really rewarding when something you fund can do well financially, but can also do good for the world. And I think this one can.
Fascinating. Ben, thanks for coming on the podcast. Where can people find out more about you?
Well, as you mentioned, my LinkedIn profile, either Ben Narasin or Tenacity Venture Capital. I take every pitch. I do specify they should pitch in a certain form, so they should actually read the headline under my picture. Also, I'm at B Narasin on Twitter, and I take pitches there. Any place they can find me, I read it all. I mean, I always wake up 400 emails behind, so I'm not always the fastest. And if it's not a fit, if you follow my process, by the way, which you'll see if you read my LinkedIn profile, then I'm going to answer you. If you don't, I'm just going to send you a picture of my LinkedIn profile and circle the line that I said. And if you don't follow my process and it's not relevant, I'm not even going to bother to respond. But I try to respond to anybody that actually took the time to look at how I'm asking people to pitch me.
So it's Ben and